Good afternoon. This is Joe Edwards, the insurance guy. And our topic for today, our little small discussion I wanted to share information with you on, was on whole life insurance. I get a lot of questions from people who ask me about whole life insurance and the benefits of whole life insurance and how does that particular policy actually work. And basically, with whole life insurance, it means just that. It's a life insurance policy that you would take out, that you would have the benefit of the policy for the rest of your life, as long as your premiums are paid. Now, you say the rest of my life, well, what if I live to be age 100? I've gotten that question. And the answer to that is pretty simple. There are different types of whole life policies with different payment periods. Some whole life policies can be paid up in 10 years. Some can be paid up in 20 years. Some can be paid up at age 65. Some can be paid up at age 80. Or you can pay until age 100. Depends on what type of policy that you choose and what type of policy that your insurance agent recommends. I always suggest, and as used as a rule of thumb, that the younger you are, the shorter your term period should be, or the shorter the period should be that you pay into your policy. So for instance, if you're a 35-year-old, I would use as a rule of thumb for you to look at a policy that's paid up at age 65. Why would I make that recommendation? Well, I make the recommendation based on two things. One, it's going to build a good cash value for you. And two, when you turn age 65 at retirement age, that policy will be paid up and you will no longer have that bill. Whole life insurance has some other benefits, which builds up cash value. The cash value is normally begins to accumulate in the second year of the policy being enforced. A portion of the premium that you pay into your policy goes into a systematic savings plan, which helps you to accumulate cash value. We say in the insurance industry, that type of money is put and keep money. You have another type of money, which is put and take money. The put and take money is the money that you put inside of your bank, and when you have an emergency, you'll use it. The put and keep money is the money you do not see. The money in your 401k, the money in your pension plan, and the money that will accumulate in your life insurance plan. And as these monies begin to accumulate, as you get older and you have an emergency or something comes up where you need to put your hands on some dollars, you have an opportunity after accumulation to take a loan on your policy. I always recommend to my clients, if you take a loan on your policy, be sure to put that money back, because God forbid if death occurs and you have an outstanding loan, the amount of the loan will be reduced from the face amount of your policy. For instance, if you have a $5,000 policy for a $1,000 loan, death occurs, your policy will pay $4,000. I appreciate you taking a look at this short video today. and I look forward to sharing more content with you in the future.